This is the video you've been waiting for, in which I'll expose the most common traps used by the big players to manipulate the market and exploit unsuspecting retail traders like you. Let's start with a break of structure trap. This is a devious ploy used by the smart money to lure unsuspecting retail traders into the market at precisely the wrong time. It's a trap that preys on the inexperience and emotional impulses of the average trader, leaving them trapped and helpless as the market turns against them. Picture this. The market has been in a steady uptrend. The buyers are in control, and the overall sentiment is positive. Retail traders, seeing this consistent rise, start to feel confident and begin looking for opportunities to enter long positions. When the market breaks above a previous swing high, it's often seen as a bullish signal, indicating that the uptrend is likely to continue. And this is where the break of structure trap comes into play. The smart money know that many retail traders will view this breakout as a buying opportunity. They understand that the average trader is trained to look for these bullish signals and to enter the market when they occur. So they engineer a false breakout. And once they lured in enough retail buyers, they abruptly reverse course. They start selling aggressively, driving the price back down below the broken swing high. The retail traders who bought into the false breakout are now trapped. They're left holding long positions in a market that suddenly turned against them. As the price continues to fall, many of these trapped traders will start to panic. They'll sell out of their positions, often at a loss, just to escape the pain. And guess who's there to buy up these positions at a discount? That's right, the smart money. They've made their profit, and they're ready to repeat the process again. I'm sure you've lost dozens of trades this way. So how can you avoid falling victim to the break of structure trap? When you see the market break above a swing high, don't just blindly rush in to buy. Instead, wait for confirmation. See if the price can sustain its move above the breakout level. First, look for increased volume and momentum to validate the move. If the candles above the previous swing high aren't backed by volume, be patient and wait for a pullback. Don't just follow the herd and assume that a breakout is always a buying opportunity. The smart money is counting on you to make this mistake. Try to think like a professional trader, always looking for bargains. The change of character trap is another cunning strategy employed by the smart money to deceive retail traders. It's a trap that takes advantage of the naive belief that a broken swing like this one signals a reversal of the previous trend. This assumption can lead to disastrous consequences for those who fail to recognize the true nature of the market. Let's break down this trap step by step. First, let's consider this market in a clear downtrend. It's obvious that sellers are in control and that the path of least resistance is downwards. Despite the prevailing downtrend, the smart money may decide to manipulate the market. That's because they always want to sell at a premium and want to find new buyers. With the obvious downtrend, not many traders are willing to buy. So smart money must do something about that. So they start buying, creating a period of consolidation or a range. This range gives the impression that the downtrend may be losing steam. The smart money will then suddenly push the price above the upper boundary of the range, breaking a previous swing high. You probably know this as a change of character. Retail traders, conditioned to believe that a broken swing high in a downtrend represents a bullish signal, start buying. They think the character of the market has changed from bearish to bullish, and they don't want to miss out on the anticipated rally. And this is exactly what the smart money was waiting for. As the retail traders buy into the false breakout, the smart money starts selling heavily, dumping their positions onto the unsuspecting latecomers. The price, unable to sustain itself above the broken swing high, starts to fall rapidly. The retail traders, now trapped in losing long positions, start to panic As the market resumes its downtrend, many will sell out at a loss, while others will hold on, hoping for a recovery that may never come. Meanwhile, the smart money, having sold at the top, can now buy back at lower prices, profiting from the misfortune of the trapped traders. The key lesson here is to never assume that a broken swing high automatically means a change in market character. Always consider the larger context. If the overall trend is down, a sudden breakout above a swing high should be treated with caution. To avoid falling victim to the change of character trap, be skeptical of breakouts that go against the prevailing trend. Wait for a confirmation, such as sustained buying pressure and increased volume, before committing to a trade. Remember that markets rarely reverse from a bearish to a bullish trend so smoothly. If the breakout is indeed real, you'll have your chance to enter your long position after the price retraces. The pattern failure trap is probably the most common strategy used by the smart money to exploit the predictable reactions of retail traders to common chart patterns. It's a trap that capitalizes on the belief that certain patterns, when broken, will lead to substantial moves in the expected direction. But as we'll see, this belief can lead to painful losses for those who fail to recognize the manipulative tactics of the market makers. It goes like this. Let's say the market has been forming a triangle pattern, with the price bouncing between converging trend lines. Retail traders, recognizing this pattern, anticipate a significant move once the price breaks out of the triangle. As the price eventually breaks below the triangle's support level, retail traders expecting a continuation of the downtrend start selling aggressively. They believe the pattern has confirmed a bearish outcome, and they don't want to miss out on the anticipated decline. This is exactly what the smart money was waiting for. As the retail traders sell into the break of support, the smart money starts buying heavily, absorbing all the selling pressure. They recognize that the break of support has likely triggered new sell orders placed by retail traders, and they are happy to take the other side of these trades. And after briefly dipping below the broken support level, the price suddenly reverses and starts climbing higher. The retail traders, now trapped in short positions, start to panic as their expected downtrend fails to materialize. As the price continues to rise, many of these trapped traders will be forced to buy back their short positions at a loss, further fueling the upward momentum. Meanwhile, the smart money, having bought at the bottom, can now sell back at higher prices, profiting from the failed expectations of the retail crowd. The key lesson here is to never assume that a broken pattern will always lead to the expected outcome. The smart money is well aware of the common patterns that retail traders watch, and they will often use these patterns against them. To avoid falling victim to the pattern failure trap, you must learn to think beyond the obvious. Don't just blindly sell on a break of support or buy on a break of resistance. Consider the larger context. Is the overall trend still intact? Is the volume supporting the breakout? By asking these questions, you can avoid being caught on the wrong side of a failed pattern. Remember, the market is not always logical or predictable. The smart money will often try to exploit the assumptions of retail traders, and they have the resources to make the market move in their favor. Patterns can and do fail, and those failures can be costly for the unprepared. The weak rejection trap is another cunning ploy designed to exploit the inexperience and emotional vulnerabilities of retail traders. It's a trap that preys on the common belief that a rejection candle, especially one with a large upper wick, signals a reversal in the trend. Let's consider this market in a clear uptrend. At this point, a bearish rejection candle forms. This candle is characterized by a small body and a large upper wick, indicating that the price rallied during the period, but was then strongly rejected, closing near its opening price. Retail traders, seeing this bearish rejection candle, interpret it as a sign that the uptrend is exhausted and that a reversal is on the cards. They believe that the large upper wick indicates strong selling pressure and that the market is about to turn down. Acting on this belief, they start selling, expecting to profit from the anticipated decline. But contrary to the expectations of the retail traders, the price doesn't reverse. Instead, it continues in the direction of the initial uptrend. The bearish rejection candle, despite its ominous appearance, proves to be a mere blip in the ongoing upward movement. The retail traders who sold on the appearance of the rejection candle are now trapped in short positions as the market moves against them. As the price continues to climb, they face increasing losses, and many will be forced to buy back their positions at a higher price, further fueling the uptrend. The key takeaway here is to avoid trading against the main trend based on a single candle formation. A rejection candle, no matter how impressive it may seem, is not a reliable signal for a trend reversal on its own. The smart money understand this, and they will often use these candles to their advantage. After the rejection candle forms, the smart money will start buying, absorbing the selling pressure from the retail traders. They recognize that many traders will interpret the candle as a reversal signal, and they are happy to take the other side of those trades. To avoid falling victim to this trap, you must learn to think beyond single candle formations. Look for other signs of strength or weakness. Again, check the volume. There are specific VSA patterns that may confirm or reject your bias. Always remember that a candle that seems to signal a reversal may, in fact, be a mere distraction in the larger trend.